Welcome to Nasdaq Trade Talks, where we meet with the top leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Russell Rhoads, Associate Clinical Professor of Finance at Indiana University, and Dan Deming, Managing Partner at KKM Financial. We're here to discuss why the market narrative will continue to be rate-driven and levels to watch in the VIX. It is great to see both of you, as always. Welcome back to Trade Talks. Russell, it's interesting that you think we're going to be focusing on what's happening with the December Fed meeting and the Fed going forward. And it seems as if everyone's trying to guess what the new administration is going to be doing. At least there's somewhat of a line of sight when it comes to Fed policy.
Yeah, there's definitely a line of sight. And thank goodness we have derivative markets that'll give us an idea of what the market is really thinking as far as putting money to work. And the reason I'm so fixated on what the Fed's up to is when we would get the minor sell-offs that we had in 2024, you would see a change in the anticipation as to what the Fed was going to do and when they were going to do it. And typically it was pushing out cuts farther, or maybe the cuts aren't going to be as aggressive. We got our first cut back in August. We're all aware of that. The 10-year rate was at 3.8% when that happened. Last week, the 10-year rate got up to 4.5%. So the 10-year rate is indicating that, and the derivative markets are indicating that the bottom for rates, which a couple of months ago we thought would be December of next year, they're actually pushing it all the way out to January of 2017 now. In both instances, they're expecting rates to bottom around 3.5%, but we're looking at like a 2-year slow, boring cutting cycle. And that combined with, and a lot of people don't equate low volatility with Trump, but I think the lowest realized volatility market we've had in some time was one of the years that he was president, maybe his first year. I can't remember the exact one. So as volatile as the news always sounds, I don't know if we're going to have a whole lot of volatility going into 2025.
Yeah, which is interesting. And Dan, I want to get your thoughts, how the VIX is looking at it. And of course, seasonality as you come into December. But I recall that period, to Russell's point. I mean, the S&P was maybe moving 3 to 5 handles a day. It was a couple of years where it was frustrating for traders, right? There was no volatility in the market to trade. Meanwhile, you kind of get to Russell's point, the headlines of we can expect volatility to come back and, very transactional policy and so forth. But really, I mean, nothing transpired from it, which I think, makes sense why we should be looking at what's happening with inflation and the Fed and so forth. We'll get into that in a moment. But what are you seeing in terms of the volatility markets and the levels where the VIX is?
Yeah. So Jill, I mean, I think you brought up some great points there as far as the expectations versus the reality. And so when you look at the market now after the post-election and, the fact that we've been able to maintain this upward momentum to this point going to the end of the year, you're seeing seasonality really start to take hold. And in that respect, historically, December has been a very good month for the equity markets. And with that, we're seeing the VIX now pushing back down towards the lower end of the range for the year. And also, so realized volatility is coming quite a bit here in the last 3 weeks. And the expectations are based on the price action that's going to maintain here through the end of December. Also looking at the term structure in the futures and what would be considered normalization in the futures market. And what that means is the basically a staircasing of premium in the futures market going into the middle of next year is in a fairly orderly, normalized fashion where we have not experienced that throughout 2024 because of the election bump and the uncertainty surrounding the election. But now we're through that. And with that, we're seeing the futures market normalizing and seeing what you would consider more traditional premiums to cash in the futures market as it does show that contango going into next year.
Yeah. So, Russell, it seems as if the pendulum switches back to what we're seeing with macro data, right? Because you're going to be thinking about inflation, employment numbers. That's certainly going to be a concern if we know what the path is or what the market's pricing in for the next 2 years in terms of rates. It seems as if it's just going to really be hyper-focused again on data outside of, what's happening geopolitically.
Yeah, I think we've definitely shifted very, very quickly. And I think a big fear we had was that we would have a protracted situation where we weren't sure who was going to be in power in 2025, and that didn't happen at all. I mean, right. we were pretty much done that evening. So I think the focus is back to economic numbers. We've had a lot of situations where raises have been given out. And we've had a couple of strikes that have pushed push salaries higher. So I feel like if any inflation scare comes along, it will be able to pick up on it first by looking at the wage part of the employment number that comes out this Friday. So I've got a pretty close eye on that number. It hasn't come down quite yet. It's stayed pretty steady, but I feel like that would be the canary in the coal mine if we're going to get another bout of inflation. And if we do get another bout of inflation, that's the kind of thing that would push the Fed out as far as their ability to cut rates.
Yeah. Dan, it's so interesting. Anecdotally, we were in Asia during the election. So when the polls closed, it was Wednesday, 1 p.m. on the ground in Singapore. And we had people from, virtually every nation at this particular conference. And it was almost like a collective sigh of relief that the outcome was so definitive, and that there wouldn't be that uncertainty in the U.S. markets or in the political and social system for prolonged, as we saw in 2020, and it was almost surprising just how quick the volatility and the uncertainty came out of the market. I think it surprised many of us on the ground there. Do you think that the VIX and what you saw here was reflective of that?
Yeah, I do. And I think that that's accurate because there was a great deal of uncertainty going into the election, and that the resolution, we were not going to go over the results for weeks, if not longer. And then but as you pointed out, the fact that it was it was clear cut, and it was pretty much understood by the end of the evening that it was going to be a change in administration. And with that, that really shifted. It took an unknown and turned it into a fairly confident known outcome moving forward. And that's where we did see a big drop in the VIX. And the interesting thing here is that when you look at the activity in the VIX options, we're seeing big open interest now in the puts, which is something I think that really picked up after the election, as the 13 strike for the December expiration is the biggest open interest that, as far as I could see, in the put side of the VIX options. So there's expectations that the cash is going to continue to fall heading in towards that expiration cycle. And also you're looking at the VVIX, which is a measure of implied volatility in the VIX options, continuing to move lower. So again, the expectations are that we're going to see a pretty benign end of the year as far as activity in the SPX or volatility, and then also volatility within the VIX space. And the expectations are right now, based on open interest, that the cash is going to continue to move lower.
Yeah, and Russell, it's interesting. You picked up on a trade in the Nasdaq 100 index options that stood out to you, which appears to me to tell somewhat of a different story.
Up, so don't try to take quick notes here. It'll appear on the Nasdaq website late today, probably more likely early tomorrow. But somebody came in middle of last week, and using the December of 2025 options, they purchased 3 of the December 2025 16,500 puts for every 2 of the December 2025 25,000, love that strike price, calls. And they purchased the puts for 368.80. They sold the calls. They sold a fewer number of calls for 421.20. The net result was, I think, a cost of $88 per spread. However, they still, they've got a little bit of powder in their back pocket as far as being able to maybe sell some more of those 25,000 calls if the NDX starts to move higher. And when I was at the Options Institute, we weren't really allowed to talk about actively hedging, et cetera. But I like when you see an imbalanced collar like this, and it looks like somebody might be trading around one side of it or the other. So I'm going to keep a close eye on those 2 options, I guess, for the next 13 months.
Yeah,
but that's a really good, I think that's a really good way to go about hedging, but also having some flexibility to maybe sell the rest of those calls at a higher price.
Exactly. If I could just piggyback on that, Jill. I think it's prudent right now, given the fact that we're closing out the year at basically all-time highs, and putting on the collars or risk reversals or whatever term you want to use for them. It makes sense from a risk management standpoint. It still allows you to capture the upside. And as Russell pointed out, they still have the opportunity to potentially sell more calls to turn it into even a credit spread ultimately if we see a higher price action. But at these low volatility levels here, as we enter this cycle through December and the market at all-time highs, it's not surprising to see market participants looking for opportunities to hedge some of their exposure to the equity markets.
You know, especially the Nasdaq 100 when you have that risk
Yes.
concentration as well, because you know the narrative in 2024, even last year was as goes the Mag 7 goes the market, and of course the Nasdaq 100, that's where these companies live. Obviously, they're in the S&P as well, but you would expect that structure to look a little bit different because of the weighting and the way these indexes are constructed. So while the positions theoretically might appear to be opposing to each other, they do make sense practically.
Yes.
All right.
Yeah, absolutely. I mean, if Russell wants to take that, but I think they do. And, those are things that we're evaluating heading into 2025 because, you got some significant gains in particularly, as you pointed out, the Nasdaq, but the S&P and really all the major averages now. And individual stocks as well. So looking for ways to mitigate some risk heading into the new year, and particularly if you don't want to have the tax consequence or things of that nature, it certainly makes sense to possibly lay off some risk by collars or risk reversals. And again, that's not necessarily turning bearish. It's just taking using the opportunity here with low volatility to again maybe reduce some outsized moves in the market. Should we see some increase in volatility heading into 2025?
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.